UK inflation came in lower than expected in August, falling for a third straight month. Consumer prices fell to 6.7%, the lowest in 18 months, due to a slowdown in food inflation and a decline in accommodation services. On a monthly basis, headline CPI rose by 0.3%. It comes despite a sharp rise in fuel costs over the month. The surprise drop in UK inflation pushed down the value of the pound against the US dollar and euro in early trading, as traders bet the Bank of England is nearing the end of its hiking cycle. Let's get more on this now with Danny Hewson in Huddersfield in the UK. She's Head of Financial Analysis at AJ Bell. Danny, thanks for joining us this morning. Now, why was this surprising for markets, and will it have any effect on the bank's decision on Thursday?
It was surprising because, as you say, we have seen prices at the petrol pump creeping up quite a lot. In fact, the ONS said that fuel costs had risen by 12% over the month, which is a significant amount, particularly when people are already dealing with high prices elsewhere. This surprise fall in inflation has led market expectation of an additional rate hike of a 0.25 percentage point tomorrow to fall from 80% to 50-50. The bank is still in a very precarious position. We are still talking about inflation, which over the year, the OECD estimates will be the highest of any G7 country. So still pressure on the bank to really continue to clamp down hard on it. But as you say, the economy has been slowing. There are signs of a few cracks forming, and it might just provide the bank enough wriggle room to pause rates, at least for now.
Right, now the government has pledged to cut inflation to 5% by the end of the year. Given these sharp rises in fuel prices, does that seem attainable?
I think everybody thought yesterday, before we had this surprise cut in inflation, that it was really 50-50 as to whether or not the government was going to meet this target of 5% by the end of the year. As you say, we saw the cost of a barrel of Brent crude top $95 a barrel. It has slipped back a bit since then, but that is causing pressure on things like producer price inflation, which did go up month on month, although year on year it has come down. So I think at the moment, the expectation is they might just make that target, but it's still going to be pretty tough.
Right, Danny Hewson there in the UK for us. Thank you for your analysis. Now to other top stories from around the world. China's central bank has kept benchmark lending rates unchanged amid fresh signs of economic stabilization following a series of stimulus measures. The one-year loan prime rate was held at 3.45%, while the five-year LPR stayed at 4%. Recent data showed that retail sales and industrial production in the world's second largest economy had grown more than expected in August. Canada's inflation rate has increased more than expected to 4% year on year. It was the quickest pace since April after a 3.3% increase in July. The jump in inflation was due to higher fuel prices. Despite the reading, analysts expect the Bank of Canada to keep rates unchanged at 4%. And Uber has warned that the EU's proposal to grant labour rights to people working in the gig economy would force it to raise prices by as much as 40%. The ride-hailing giant said the move would also lead to the halting of its operations in hundreds of cities across the bloc. Last month, the company reported its first ever quarterly operating profit, following years of heavy spending.